Hello, everyone. This is Omar Khan. I'm the founder of Boardwalk Wealth. I have the immense pleasure of having Eric Wong, our Chief of Staff, with us. And this is our State of the Union address for the first quarter of 2023.
Hey, everybody. So we have a lot to cover today. So essentially, we're living in interesting times. There's a lot of uncertainty, especially a lot of economic uncertainty. And we know you have a lot of questions. So we want to tackle these questions head on. We want to keep everybody informed, and we're going to explain to everybody how Boardwalk Wealth is handling the current environment, how we're handling our portfolio, and how we're going to handle your investments with us. So essentially the agenda items, we have a lot of things to cover. So we're going to cover macroeconomic trends, interest rates, risk mitigation strategies, and then we're going to go over our portfolio, and then we're going to talk about deal return expectations. And then we're going to end off by talking about the outlook for our future offerings. Before we jump in, Omar, can you give us a quick note about our track record and your background, especially why you might have a unique outlook, being a CFA, of course, and why our listeners should listen to you and your expertise?
So I've had the CFA charter for over a decade now. And just to give you some background on the CFA, it's a gold standard in portfolio and risk management. I mean, there's 3 levels to becoming a CFA charter holder, and the passing rates are actually significantly lower than the American Board of Surgery. Now, I say this just to give you a background on how rigorous the academic and professional training goes into getting the CFA and how much of that I had to go through, right? To give you an example, that, when we look at stuff, we look at it across the business cycle. And this is a topic we're going to come back to over and over again during the course of this talk, that you can't just look at stuff in 1 year or 6-month increments. You have to have a long-term differentiated view. So the CFA charter holder, all the academic and professional rigor that goes into it, my background in institutional finance, it's helped provide me, unique experiences, especially as I've done over $4 billion of capital financing and M&A transactions. Now, in our current portfolio right now, we have about 10 multifamily assets spread out across Texas, Georgia, Florida, and South Dakota. But I also want to note that we have a select menu of options in select niches, like our QSR fund. It's a high-yielding, high cash flow fund. We launched it about a year plus ago. And the entire reason for that was to offer differentiated diversification, which is, the typical idea is if you're in multifamily, guys say they're diversified and go to self-storage. I mean, nothing wrong with self-storage, but you're not really diversified. So the whole idea there was to go into a differentiated niche, which was not linked to real estate. So then we could offer true diversification to our investors. And lastly, what we also have is a distressed multifamily fund, which allows us a unique input and view into the market to see what's going on, where are people faltering and where are people not faltering. But, why don't we get into it and we can talk about it more, Eric?
We'll start off with the first section. So let's talk about macroeconomic trends. We're going to answer the first question is, generally, where is the economy going? So Omar, can you tell us, are we risking a recession, or how's the financial media framing it? Or are we in a recession? Are we in a recession already? And can you talk about some of the major trends that are affecting the economy right now, which in turn affects our portfolio?
I recently got into a little bit of a tiff online with one of the chief economists of the Fannie Mae, who insisted, this guy's still insisting, that it was, and I'm quoting him here, so I have to read off the screen, it was and still is valid to judge inflation as transitory. And we all know these types of comments really haven't aged really that well. The president just unveiled a $6.9 trillion budget plan, including $5.5 trillion increases in taxes over the next decade. This is on the heels of the last administration running record level deficits, and increasing the money supply by over 30 to 33%, according to some sources. So now the issue is both sides of the aisle are committed to spending your dollars, just in different ways. And the problem is this puts the Fed in a bit of a pickle, because the Fed has a dual mandate of both managing price stability, which is basically price stability inflation, and maximum employment. And these are oftentimes divergent sort of mandates, because the problem is right now, if they have to manage price stability, which is inflation, if you want to manage inflation, there is not a snowball chance in hell that it doesn't result in an increase in unemployment, which means you don't have maximum employment. So there's a bit of a balancing act that's happening there. And the other thing is, while the Fed only controls the monetary aspect of things, and let's assume they control it, they use all the tools that are at their disposal, which, I mean, they have a mixed record of doing that. The fact of the matter is the government fiscally is continuing to pump money into the economy. So the Fed can do whatever they want on one side, but if the government is doing the exact opposite, you're going to have a muddled policy, right? So that's the issue. That's why fighting this inflation part is going to be very hard, because you might come down from 9 to 5 within a reasonable period of time, but getting from 5 to 4 to 3, it's those last 100 basis points, 300 basis points that are the hardest, right? So there, like I mentioned, there's many inflationary pressures. Now, the issue is compounding all of this stuff is the recent banking failures. Now, we knew if rates were hiked at this fast of a pace, which is a record in recent history, something was going to break. And that something wasn't one bank. It is multiple banks. This is a plural. Multiple banks have failed. We've had major blue chip private equity firms like the Brookfields, the Blackstones, KKRs, Apollos, all of these. They're handing back the keys to some assets in their portfolios back to the lenders because they just don't see a way out. So while we may or may not technically be in a recession, for all effects and purposes, we kind of should act like we're in one now. And because there is a hard probability of a hard landing, I mean, that's just the reality of the situation, right? And I tried finding better ways of saying this. So in essence, the fear isn't necessarily what is happening right now or what has happened, say, in the last 1 week, 2 weeks, 1 month. The fear is basically how many monsters are lurking under the bed and what is going to come. Because the problem with each recession is we know this playbook. Things start breaking and it starts really slowly and then it starts expanding. So on existing assets, we feel that the best strategy right now is to hunker down for the next 6 to 12 months, continue to prove out the business plans, because across our portfolio, and we're going to get into it, we continue to see rent growth, right? Because we selectively bought these high quality assets. We continue to see rent growth. So the plan, 6 to 12 months on existing assets, hunker down, prove out the business plan, push up values as much as possible. But with all this stress in the system, what we're also seeing across the board is a multitude of opportunities that are rising up. I mean, as I alluded to earlier, I have a rescue capital distress type fund where basically I get to see a lot of distressed deals that come through my desk. And that allows me to cherry pick, the best deals for ourselves. So when we see that type of deal flow, that volume of deal flow is already picking up. So on one aspect, you got to hunker down 6 to 12 months, continue proving out the business plan. But, wherever there's danger, there's lots of opportunity.
So you mentioned two words that are quite scary to most investors and to most astute people, which is recession and inflation. So let's go into a bit of detail into each one and just briefly touch upon how each of these scenarios or those scenarios affects real estate overall.
So look, in a recession, you typically start getting higher unemployment. As unemployment starts ticking up, there is major negative sentiments, prices of valuations of assets go down, and closing deals at this time, when oftentimes you are literally getting the best possible deal. Closing any sort of transaction at this time is the hardest, even though it is the best time to close on deals, right? So a lot of investors shy away. On the flip side, in an inflationary economy, the price of everything goes up, right? We've just gone through a recent event, I think from around the time COVID happened to, we're kind of still going through it right now, but let's assume last year, there is no price big enough to pay for an asset. And we've all seen how the story ends. This party doesn't last forever. The hangover is severe. Now, another issue becomes, what do you have when you have both high unemployment and high inflation? And the last time we really experienced this in this country was in the 70s, where we had a stagflationary economy because the prices of oil went up. And the specter of that possibility is especially jarring and scary for the government and bureaucrats. And they are heavily trying to thread that needle and trying to get us out of a scenario where we don't have high unemployment, but we also don't have high inflation. Because those two things combined, they're the kiss of death, basically.
All right, so on the topic of rate raises, we're going to get deep into that into our next topic. All right, so the next section is interest rates. So Omar, tell us a little bit about interest rates, and in particular, the direction that you see them going and the level of certainty that or uncertainty in the market. So just dig into your crystal ball and let our investors know what you think.
Well, Eric, first of all, I wish there was some level of certainty. There isn't, and that's what's compounding all of these issues. So in the last FOMC meeting, the Feds raised the rates by 25 basis points. The market had somewhat priced this in, but the Fed did leave the door open for either a mild increase, another say 25 basis points on the next meeting in May, or a pause, after which a potential pause can occur. Let's see what happens with a cut. So the market, though, still is pricing in rate cuts. And I wanted to share some interesting slides over here just to share with our listeners. As you can see here, the volatility in the market has really risen. In fact, we sourced this from Pensford. JP Conklin did an excellent presentation recently. And what you can see on the screen over here is, following the SVB fallout, the interest rate volatility has reached the highest peak since the Lehman collapse in 2008. Now, that is very especially jarring, right? Now we go to what are some of the leading economic indicators. Again, sourced from Pensford, right? Leading economic indicators right now are deeply negative, and they have always preceded a recession historically. And like I said, it's not what's happened in the recent past or what's happening right now. It's the fear of what will happen in the future. Now, when you combine high volatility, negative economic indicators, what happens? In this particular scenario, the market right now, surprisingly, is factoring in rate cuts. I personally think that's a bit of hopium, because I think the Fed will lose a lot of face if they do this. But as weird as it sounds, from the rates perspective, bad news is good news. In other words, if we have, God forbid, another banking failure or some other severe negative economic outcome, then the Fed is likely to pause or even reverse course on their rate hikes. So, in a nutshell, the issue is added volatility spurred on by the collapse of the banking system in certain regards has basically put the Fed in a very weird position. They have to go ahead. They have to keep raising rates if they want to manage inflation. But if they keep raising rates, there is a lot of collateral damage along the way. So at current levels, refinancing assets, as we've seen, a lot of times people want to get out of debts, go into different type of debt, long-term debt. Refinancing assets from a real estate perspective is next to impossible, right? But any decrease in rates, let's assume the market is pricing these rate cuts, and they actually do happen, right? Any decrease in rates will add substantial relief to real estate investors and sponsors. But all of this volatility, all of this negative news that you're hearing that I'm telling you, but this is in stark contrast to what's actually happening at the property level, where we're having some of our best operational years ever. So it's really, a tale of two cities here. It's very interesting, and it's just very volatile right now.
All right, well, thanks for clarifying that. So on the topic of rates and types of debt, you talked about this at length before, but it's always good to revisit. So why don't you tell our investors the types of rates and the types of debt that we tend to use and why?
So we have both floating and fixed rate debt across our portfolio. As I've explained earlier, the reason for this is that we match the type of business plan we have to the type of debt we get, basically. So let's assume the business plan is, say, a 1, 2, or maybe a 3-year exit type situation. In that scenario, getting fixed rate debt is often a losing play. Now, just to be very clear, what this happens is you have to get floating rate debt. That is a smart way of doing these things. But that obviously has come under considerable duress in the last year or so. Now, on our development, this is typically on the acquisition side, right? Because that's a quick get in, get out a lot of times. On the development side, we've always had fixed rate debt because there is added complexity in those projects. But regardless of whether we have an acquisition or a development, if we get floating rate debt, we always get a rate cap because it's an insurance-like product. We're going to get into all of this. But right now, we're continuing to monitor our portfolio. We will continue going forward, also have a mixture of fixed and floating rate debt to ensure that across our portfolio, we have the maximum flexibility.
Yeah, the thing is with life is you have to be flexible. And anyone that's ever saying, oh, you must do things this way, or you always have to do things that way, they're not really thinking about the bigger term picture. So you brought up rate caps. So why don't you go into a little bit of that into detail. So talk about rate caps for variable rate loans. And could you reiterate what a rate cap is and talk about rate caps in terms of our current assets?
Eric, I think I'm going to get into all of this, but I was just thinking it might actually be a good point that we should put. I had about a 45-minute to an hour-long video on what rate caps are, how are they calculated, that I posted a little while ago. So, Eric, maybe we can put some of that link in the notes as well to share with the listeners. But look, interest rate caps in a nutshell think of them as insurance-like instruments against rising interest rates. So we always get rate caps on all of our floating rate debt. So this is how basically an interest rate cap works. What happens is you buy a contract that says if rates rise above X, whatever that number is, right? Whatever rise above that, whatever additional costs are going to be incurred, your counterparty, the person you are buying a rate cap or this insurance-like product from, they are going to pay you. And the reason why, smart sponsors like us get it is because in the off chance something happens, you want to have insurance, right? The whole point of insurance is hoping you don't need it, but if you need it, then you better have it, right? So in our particular case, this has come in particularly handy in the last few years because we have been getting reimbursed anywhere from, I think, $15,000 to over $30,000 per month, depending on the properties, because of the rates rising, because we had this insurance in place. To give you an example, on Equinox at night, we've refinanced that property twice. So in the first refinance, when I did it in 2021, I got a rate cap for something like $25,000, $30,000. We refinanced that property again in 2022. And because of that, I had to get another rate cap. But check this out. The $25,000 to $30,000 rate cap I bought in 21, which was just a year ago, and if you're in 2022, well, I sold that close to $900,000. I bought the next rate cap for about $650,000, $700,000, and we pocketed the difference. And the point that I'm trying to make is that when you have good, effective hedges and insurance products like this, you can withstand a lot of stress in the portfolio. So across our portfolio, I make it a point to not just have rate caps, but as an additional risk management process, stagger these rate caps. When do these rate caps expire? So to give you context, in all of 2023, we only have one rate cap expiring. In 2024, at the start of 2024, I think in March or April, we have one rate cap expiring. We have one in July, we have two in October, and the rest are all in 2025. And the reason why I do this is because this is simple risk management. When you stagger out your loan maturities, when you stagger out your rate caps, you're not exposing your entire portfolio to negative events, right? And a lot of times people only look at the upside. But the way we look at it is, how do we protect the downside? How do we maximize principal protection? Because if we can do that, then the upside takes care of itself.
Okay, so rate caps are definitely one mitigation strategy that we use. So let's talk about our next section. Right, so our next section, we're going to talk about the overall risk mitigation strategies that we use as a whole. So before we go on talking about risk mitigation, I just want to say that Boardwalk Wealth has never done a capital call. We don't plan on doing capital calls, and we have a specific avoidance of them, which is one of the hallmarks of our ongoing strategy. So, Omar, please tell our investors the current state of multifamily and other operators asking for capital calls for their investors. And you see a lot of sponsors on other deals because we have a rescue capital fund. So tell our investors a little bit about that and just overall the general state of capital calls in the industry.
I've had a lot of investors, as you know, Eric, they forward me emails about capital calls that other sponsors have sent them. In fact, I've heard some of the bigger sponsors initiating capital calls across their entire portfolios. There is actually a big syndicator. He's got I think about 5,000 or 6,000 units in Houston who didn't have good risk management and now is basically getting foreclosed across pretty much his entire portfolio. So while these are drastic examples, I do think this trend will accelerate and stay elevated for a little while because people don't pay attention to risk. Everybody talks about returns, but nobody talks about risk management. And risk management is step number one. So many sponsors, as we know, are over-leveraged. They're in the wrong markets. They've overpaid. They have poor operations. And unfortunately, look, it's sad to say this, but a lot of these sponsors and investors, well, they're going to be in for a rough time. So And as Eric mentioned, we've never done capital calls. We don't plan on doing capital calls. But the fact is, because we've got multiple angles through which we look at, what we buy, what we develop, which is a good point of that is a rescue capital fund we have. Because I can see a lot of distressed deals, I have a good pulse into the market of what's going on and how people have not managed their risk, which then allows us to become better operators and managers.
Yeah, and this really goes to speak to our conservative strategies that we use and having your CFA background, because essentially you're managing risk for multiple large billion-dollar portfolios. So that really comes in handy. So let's talk about a topic right now that are in a lot of investors' minds. So that's the decision to temporarily pause distributions for properties. So let's explain to investors why you came to that decision and how that's going to be a good decision in the long run.
Well, Eric, thanks for asking all the easy questions. Right. So look, on select properties, I've taken the decision to pause distributions. This was contrary to the feedback that our accounting and operations team have given us. I mean, look, in fact, if you look at our financials, you look at our rent growth, you look at our expense management, our NOI is continuing to trend up across our portfolio. Our cash position is good. We're still cash flowing pretty much across our portfolio. So you would think to yourself, well, what's this guy afraid of? What's going on? And the answer is very simple, guys. I've seen this story over and over and over and over again. This doesn't end well. The economy doesn't just collapse in one go, or recessions just don't happen. Like, it's not like April 1st, a recession happens, but March 31st, everything was fine, right? Like all things, it happens slowly and then very quickly. And as stewards of your capital, look, we're a family-oriented firm. My family's been in business. I'm the third generation. The foremost thing we've always prized is principal protection. And everything we do in this firm, from the way we structure our deals, to the way we finance them, to the way we operate them, it all revolves around the basic question of risk management. Number one, we have to protect our principal. Number two, we then worry about making money. So risk comes in many forms, right? And the issue is, there are many ways that we can mitigate it. In our particular case, we raise adequate cash reserves. In fact, we've over-equitized on deals. This has actually slowed us down, because a lot of my partners would keep telling me, well, why do we have to go raise more money? Because obviously, the more money you raise, the longer it takes to close on deals, right? Why do we have to do that? And I've seen from my personal and professional experiences that you need to have a fortress balance sheet, because eventually good times don't last forever. Bad times come, and in those bad times, you don't want to be swept away. And again, I have seen the story over and over again, right? So the current fear and trepidation is more along the lines of, look, what is happening? What is going to happen in the next 6 months? What is going to happen in the 12 months? And as you saw, and as our investors know, the reality is operationally on all of our properties, these are some of the best years we've ever had. So given my experience, and I mentioned this over and over again, I have to hunker down for the next 6 to 12 months, continue proving out our business plan, because we're still getting those rent pops. We're still managing our expenses, right? And continuing to push our value. In my opinion, this is not the time to be a hero. This is rather a time to be aggressively conservative. And what I mean by this is, you have to aggressively implement your business plan, have high cash balances, you have a good balance sheet, because cash is king, right? But if things go sideways, you need to have enough power, because you have a good balance sheet, to withstand any negative economic events, right? So examples we talked about earlier are staggered loan maturities, staggered rate cap expirations, and all of this is a means to intentionally ensure that we are slow and steady, because our point is to not win just this battle. Our point is to win this entire war, which is across a business cycle, right? So the reason is, for all of these things, comes down to the CFA background that I have. It's all risk and portfolio management, guys. We want to stagger all of these things. And while understandably I empathize, I mean, some investors are concerned, our whole operating philosophy is centered and always carefully on tending our portfolio. Like I mentioned, taking that middle path, slowly and surely playing to win the battle. And look, this might be a scant consolation, and my team didn't want me to say this, but this might be a scant consolation. But unlike most of my peers, I am not looking to make a quick buck. I'm already very affluent. I personally sign on all the loans. I'm heavily invested in my projects, and I have ample skin in the game. But all of this, pausing or not, it affects me in multiple ways, selfishly speaking, because it makes it harder for me to go back to our investors a lot of times and raise money from them, because understandably say, well, you've paused distributions on certain projects. So we have to take the long-term view and show to our investors through our actions long-term that we're doing this to be effective stewards of capital. But I would much rather take this pain up front in the short term and be an effective steward of capital, even if it comes at a considerable amount of pain.
Yeah, this is just kind of a basic adage in life is, you take the short-term discomfort for long-term gain rather than just kind of just eating your cake right away and then, just having temporary pleasure. But then in the long term, you're kind of suffering. So I also want to point out the fact that that's what the preferred return comes in. So all these amounts are owed to the investor as a preferred return before you or the GPs can take part in profit sharing. So that's a very important thing to distinguish right now. So let's go into the next topic, or the next question is, how are you viewing market conditions? So what indicators are you looking at? How have you stress tested to assess the health of our assets? And then can you go over some of our other risk mitigation strategies?
Of course. So look, currently, as we all know, the macroeconomic news is very negative and very bad. But again, mentioned this earlier, the story of their properties, it's a night and day difference. I mean, our properties are some of the best years we're having, right, operationally. Fear is what's happening in the future, not what's happened in the past or what's happening right now. Now, to be very clear, some things are always going to stay the same regardless of market conditions, right? We're always very operationally driven. We'll take a deep dive into our asset management. So to give you an example, this includes bi-weekly meetings at the corporate level, as well as multiple meetings during the week at the property level, where we talk to property managers, leasing agents, maintenance people, regionals, all of this stuff, right? This is coupled with frequent and surprise visits to property. In fact, within 2 weeks, I'm actually going to Atlanta, and most of my team doesn't know that I'm going there, right? Because I like to make unannounced visits to my properties just to make sure that the team is functioning and what they're doing, what they say, and say what they're doing. We've always managed to our budgets religiously, and we've always thoroughly audited all the revenues and expenses. In fact, we've always prided ourselves on having a great back office, even though it comes at a considerable expense. Because again, I have seen this story over and over again, guys. People, especially syndicators, they are so enamored with doing deals because everybody's a deal junkie. That's where they get all their fees, that they don't dot their I's and cross their T's. They don't have good controllers. They don't have good accountants. They don't have all of this stuff. And all of these things, when you don't audit your stuff, you end up losing a lot of money over the long term. Some of the additional steps that we're taking, because cash is king, as I mentioned, we have rolled out cash flow forecasts that are both within intra-month. So let's assume I might say the 10th of the month, where does my P&L look, say, by the end of the month? Also, we are paying additional, even more scrutiny than usual on the 3, 6, and 9-month glide paths to our cash flow and liquidity. We've greatly reduced our expenses, and a lot of the accounting folks will really appreciate it. We've tilted the cash conversion cycle somewhat to our favor because we have a good reputation. So if we were paying our vendors out in 30 days, we're net 60 days. So accounts payable, we are paying people over a longer period of time, but on accounts receivable, which is money that people owe to us, if we were net 30 collectors, we're net 15 or net 20 collectors. What this means is, if earlier we were collecting our funds in 30 days, we are now collecting our funds in 15 to 20 days. So what does this mean? We're collecting our funds quicker. We are also, inflows are coming quicker. Outflows, we're stretching them out. So this means we're stretching out our cash over a longer period of time. And we can only do this because we have a great reputation with our vendors. This is like credit in the bank, right? You build up your credit during good times. So when invariably some bad times happen, you can utilize that credit without exhausting your relationship. Lastly, we're focusing on occupancy maximization over revenue maximization. What does this mean? 2 or 3 years ago, if I had a unit where I knew I could get a rent at, say, $200 above where I was right now, I would have maybe waited an extra week or so, right? Now, even if I get it at 200, if I get it at 175 or 150, I just immediately lease the units because we want to keep our occupancy as high as possible. And lastly, this is always the case, but we're always focusing on delinquency management by continuing to screen the right residents and then cycling them into our properties.
Yeah, thanks for giving the investors kind of a veer into our day-to-day operations. Again, we have a really strong team within the upper brass of the company. We have a top level, super talented in-house controller, and then we also have an external CPA team that does all of our accounting and our auditing stuff. So everything's really strong on those fronts. So that allows us to kind of squeeze where we can and just kind of plan for the future. So let's move on to the final question of this session, or the segment right here. Is we got to give people kind of a glimpse as to when do you think it is prudent to resume their distributions?
So I would love to tell you that, I have a crystal ball and it tells you exactly down to the hour and the date, basically, when this is possible, but obviously that's not possible. So there is no one factor, in my opinion, that we look at as a team in isolation. To change course on distributions, some of the big factors we look, and these are mostly all macroeconomic, where is the Fed policy going on inflation? Where is it going on rates? What is the volatility around all of these things? Because right now, it's not, in my opinion, it's not necessarily whether the rates are high or low. It's the fear of the unknown. Well, are they going to keep going up higher? Are they going to stop? Are they going to go sideways? That's what keeping a lot of people up at night. Additionally, because we're in the market, both with our distressed fund as well as we acquire and develop, we are constantly keeping a pulse of what is the volume in the market, how much deals are being traded, what price are they being traded at, and how are deals being structured. So we're always looking at that. So if, say, we continue going down this path and there is a hard landing or a recession, this means lending is going to tighten. If lending tightens, this means it's going to become harder and harder to finance new projects. If that happens, then this runway increases. But for instance, if the Fed eases up or there is a relief on the interest rates, then this runway of resuming distributions, this becomes very short and we're back to business as usual. But a lot of this is constantly monitoring the situation on a daily basis. I mean, we have our teams that are both operational as well as capital markets, which is macroeconomics. We monitor these situations because there is no one factor that if that happens, it's a green light and you go ahead.
Yeah, I don't even think you sleep because you're really honestly monitoring the situation all the time. You're up late at night and you're essentially just looking at our portfolios. And actually, speaking of portfolios, why don't we talk about that in the next section? So in the next section, we're going to go over a portfolio review. So Omar, please guide our viewers right now and just go over a brief portfolio overview of how our properties are doing.
As this is a good point to stress, and not just to toot our own horn, but because I think it gives our investors a lot of peace of mind that we're in the black for pretty much every single property, right? Now, on this slide over here, I wanted to show you the rent comparison. What happens once we take over a property? Where have we underwritten the rents and where are the rents currently? So across the acquisitions, these are the current acquisitions. We have a whole bunch of developments and a whole bunch of sold properties, right? In the current acquisitions, as you can see across the board, the rents upon takeover are significantly less. And our current asking rents are the highest. This means that our asking rents, what are we getting right now, are higher than the rents upon takeover. What happens when we take over from the property, and where did we underwrite these rents? This is a very important point because the whole purpose of this is to show you this is where basically how the sausage is made typically, right? Like how much can you push rents? And this is why taking the conservative middle paths where you don't do too many deals, you're selective, you do the right deals. This is reflective in this graph. But just to give you an example here, on this other slide, we are showing the occupancy analysis between takeover and current. So what happens when we take over a property and where is our occupancy in the current scenario? So across the board over here, as you'll witness, pretty much on all properties minus Eastwood Oaks, our current occupancy is much higher than when we took over. And I think we're only off by 1 or 2 basis points on Eastwood Oaks. I think when we took over, it was 97. And right now, our current occupancy is 96%. But if you go back to the previous slide, you will see that the amount of rents we've raised are dramatic on Eastwood Oaks. So I'll take that 1.5 point of occupancy if I can get such high rents across the board.
All right. So I just want to talk about quickly, and this goes to the importance of things that we can control and things that we can't control. So there's going to be a lot of factors in life and the economy and society or whatever that you can't control. But in our case, the things that we can control, such as adding value for residents, that allows us to increase rents. And then while we're doing our capex, we're able to do those things under budget and on time. So in the long run, if we take care of things that we can control, which we're doing now, that will lead to long-term gains, and it will lead to long-term gains for every investor. So I just brought up capex, and you talked about it as well. So why don't you talk or tell the investors how we're handling renos, capex, and will it slow? Will it pivot? Just give some insight into that.
Look, capex differences, of course, are based on the stage of ownership, but the underlying principle is always the same. If we get the reno premium, and typically we target at least an 18 to about 25% ROI, return on investment. If we get that, we continue to renovate the units, no problem at all. But again, we're monitoring this on a unit by unit, day by day, week by week basis. So on recent takeovers, we will still need to stick to our original capex plan. But again, because across the portfolio, we're getting the rent bumps, right? But on stabilized properties, we can obviously be a bit more choosy. If we're going to put in money and that only generates, say, another $100 in premium because we've already done some work before, well, sometimes you might not take that opportunity. So again, a lot of this is monitoring the portfolio on the say deals we acquired in the last year. This is business as usual. We have to renovate the units because we continue to get the rent premiums. But on older properties that we've had for 3-4 years, we can be more choosy and selectively decide to renovate the units because we've already refinanced out them a few times.
Okay, so before I move on to our next section, let's just cover a question that an investor sent to us. So the question is, given the dramatic changes in the capital markets, does that change the exit strategy on the current value add assets that we own?
Look, Eric, as you know, our philosophy has always been the same, right? People think that, if conditions go bad, if they go negative, suddenly you're going to change your entire approach to life. And I'm not that type of person because we're very thoughtful operators. Our philosophy has always been the same. How can we maximize investor returns across the entire business cycle? Not 1 year, not 2 years, across the business cycle. So in some instances, this has meant that we sell quickly because we felt we had extracted the most amount of juice from the asset and we got a really good price. But in other instances, it means we've refinanced multiple times. I mean, Equinox Ignite is a great example. We've refinanced Brighton Farms, to give you another example. So we refinance, return a whole chunk of money back to investors, and just have high, in some cases, double-digit cash flows, right? In my personal opinion, going forward, the days of flipping properties around 1 or 2 years, like a lot of guys are doing, those days are gone. They're not coming back for at least for the foreseeable future. We've always personally underwritten to a 5-year holding period. I believe that most of our assets we're going to hold close to about 5 years, give or take. But I don't expect any asset to be sold in less than 2 years. That's just the way the market is, guys. That's just the way things are, right? You can't just fix and flip these things. These are long-term assets to be held. And in whatever happened in the last 3 years, that was an anomaly. That was not business as usual. So for conservative operators like us, to be very honest with you, it's barring some of this capital markets, macroeconomic stuff, it is business as usual, right? Because we are thoughtful operators, right? We spend a lot of money in carefully thinking about, okay, what assets do we want to buy? How do we have to implement the business plan? So when you do that, these negative events can occur, but they don't necessarily rock the boat completely. But if you're with an operator that doesn't have a good back office, they don't have a good operations team, then it's going to pose a lot of problems because guys that bought assets with the intention of flipping it in 1 year, they're caught with their pants down, basically.
Okay, so let's end off that section and let's move to the next section. All right, so let's move on to the next section where we're going to talk about deal return expectations. So on the topic of projected returns, please tell us the range that we're targeting to date and if these expectations of these returns will change in the next couple of years.
Look, on the acquisition side, we've always targeted mid-teens IRR. Typically, this meant returns for the LPs, LP IRR, net of fees, were 14 to 17% in that range. I think given the current market conditions, at least for the foreseeable future, I think a conservative approach would be to have these LP IRRs to be in the 13 to 15% range, give or take, cash on cash between 4 to 7% across the board, and as things stabilize. On the development side, our targeted returns were in the 18 to 20%. Again, this is LP IRRs, right? Net of fees, not on the deal level. Right now, we're targeting 16 to 18% IRR. Personally, look, I feel this is still very healthy compared to the alternatives, like, say, the stock market, right? Where there's a lot of volatility. Some days you're down and the next day you're down even more, right? So investors within real estate, they get to enjoy significant tax advantages, reduce volatility. And unlike the stock market, which has a reversion to mean, right? I mean, if you go up, you have to go down. Real estate typically is an upward reversion. Like prices of assets typically across the business cycle keep going up.
All right, so this is a bit of a contentious question, and of course, you've never been accused of being too blunt, right? So anyone can make any projected claims that they like. It's a spreadsheet, right? It's like this modeling stuff. It's not magic. You can just throw in whatever numbers, garbage in, garbage out. So do you foresee any sponsors sticking with the same old numbers, no matter how unlikely, because there's kind of an arms race to appeal to the expectations of the investor? So what do you think about that?
Yes, the short answer is yes. Sponsors will keep doing these things to attract investors. And if investors keep confusing projected returns on a piece of paper with reality, well, I'm sorry to say, but they're in for a hard time. Look, we've had this conversation so many times with investors that it's not possible to deliver 20, 25% IRR forever. I mean, it just doesn't happen. I mean, nobody, and I'm including Warren Buffett in this, right? Warren Buffett's long-term average is not 20% IRR. These things do not exist. If you get them one-off, that's great. Entire businesses cannot be made off 20% IRRs. And this is why smart money across the centuries, across cultures, across countries, it doesn't matter. Smart money is always focused on conservatively aiming, whichever field you're in, right? Aiming to hit singles, doubles, and triples, and occasional home runs happen. But again, you can't build your entire business on home runs, or rather, you can't expect your entire investing strategy to be built around home runs. So sponsors will keep doing this. And if investors are going to confuse projected returns and marketing gimmicks with reality, I mean, then it's going to be really rough for them, right? And they're going to get hurt, unfortunately.
Yeah, that's a sobering take, because again, you can just promise whatever, and then if you don't, if you hit it, great. But then if you don't hit it, you just kind of move on, and then the investor is kind of left just to hold with nothing left, no recourse. So
I mean, you've seen the email, sorry to interrupt, but you've seen the emails we received from investors. Guys are promising 25, 30, 40% IRR, and then they do a capital call a year from it. And you have this.
It's a survivorship bias, right? Some you make a bunch of predictions, some of them hit, you can highlight those, and then the ones that don't hit, you kind of you forget about them, you never mention them again.
This is why I sound like a broken record. I mean, my kids complain about this now, right? You have to be conservative if you don't take the middle path, because in the boom years, you sound stupid when you take the middle path because everybody's making so much money. Why are you not making money? But a lot of times, all the money people have made in 3-4 years of boom times goes away in 1 year of bad times. And we never want to be in that position. We want to be in a position where thoughtfully we've curated a list of assets, we tend to our garden, and slowly and surely over the long run, we just get ahead of everyone. This is a way affluent families, affluent institutions, affluent individuals across cultures, across countries, across eras have accumulated considerable wealth. It wasn't done overnight. It was done by taking slow, painstaking steps, one step at a time.
Okay, then on that note, let's move on to our final section of the night. So in the final section of the night, we're going to talk about the outlook for future offerings. So Omar, tell us about acquisitions, developments, and then just generally the type of investments that will be open to investors in the upcoming year.
Look, the market right now is at a stalemate. And the reason for this is new value add acquisitions. I'll start there because it's a bad time to sell and only the truly distressed operators are selling. So it's a great time to buy. Well, the problem is the owners that can hold on for dear life, well, they are holding on. And there is ample dry powder on the sidelines. I mean, guys, astute investors like us, we're on the sidelines because we're circling. When does the penny drop? When do we opportunistically go into deals? And the problem is, buyers like us, we're not willing to pay higher prices just because some guy 1 or 2 years ago paid higher prices and wants to be bailed out. So the difference in what the buyers want to pay and what the sellers want to get is called the bid-ask spread. It's across all investing verticals, right? And right now, the bid-ask spread is very wide because buyers want to pay less. Sellers want to get more money, and this chasm is very wide. But I expect the stalemate to continue, say, leading up to say middle to end of Q2, Q3 and Q4, we expect a lot more forced sellers to hit the market. Again, to give you an example, I run a distressed acquisition funds. I'm already seeing a lot of deal flow hit my desk. In fact, that trickle of deal flow from say October, November of last year has become a flood right now of deals hitting our desk. This allows us to not only see what's going on in the market, but it allows us to patiently pick the right opportunity and the right asset in which to invest. So the smart money right now across the board is going into two types of play: high cash flow operating businesses and multifamily developments. Now, high cash flow operating businesses like our QSR fund, which can pay out at over 13% a year, is a big hit with investors. It's a stable business, seasoned operating team, highly diversified, not linked to any real estate, zero debt on the business. So this is a very attractive feature to a lot of our investors. Multifamily development is another smart play a lot of us are doing. In fact, we're just closing our latest development, Briarwood Reserve. We got record amount of investor interest in it. And the reason is very simple, that even in this high interest rate environment, because of all the value we're adding, right? We're taking this land, we're developing from the ground up. We're adding so many layers of value that the returns we can get, the value add acquisitions, they just can't compete right now, essentially, right? And look, to give you an example, Blue on Lorraine, it's the first development we did in Sioux Falls, right? We underwrote to, I think, about $1,200 to $1,400 a month in 2-bedroom rents. We've already started the pre-leasing because we're going to deliver that product very soon. We are pre-leasing 2-bedroom units at between $2,500 to $2,800 per month. This is significantly above what we underwrote, right? Another example is the Veltice. We conservatively estimated that we were going to have roughly about a $24 million loan, give or take. But because we were able to cut our costs, because we had a lot of efficiencies, our all-in costs came in at about $19.4 million. So all of this upside, this obviously goes to the investors, our investors. And the reason is because we're adding so much value. When you add value, you're able to push a lot of levers. And this is not a pattern, by the way. This is a pattern, by the way. It's not an exception. Because when I'm seeing in Sioux Falls as an example, because we have a great local team, our construction costs are lower, our operating expenses are lower, our rent growth is similar, the nominal rents we get are very similar, if not more than what we're getting in Dallas, Atlanta, Central Florida, where I actually own assets. So it doesn't take a rocket scientist to figure out if your costs are lower, your rents are similar or higher, therefore you are going to be yielding and making more returns. And this is why when we're able to go into these specific niches, specific markets, that's where you find, the real riches. Because if you're going to do what everybody else is doing, your returns are going to be very similar to what the market is. We want above market returns, right? So because we add so much value, we do a lot of research, we're very thoughtful in the way we cultivate our portfolio. This is why we're able to get all of this thing. So again, to wrap this up, I feel acquisition activity will pick up around Q3, Q4. Smart money is going into high cash flow operating businesses like our QSR fund and multifamily developments, basically.
There's a lot of uncertainty out there, but again, we've wrapped things up and there's a lot of opportunities as well. So we're going to be looking for these opportunities and we're going to be ready to pounce at the given chance, right? So I hope this answered some of the questions that you, the investors, have for us. And we're going to be sending you a survey just to touch base. We're going to have kind of a bit of some questions for you, what your outlook is, what your plans are. Be on the lookout for that. And we're always open to answering questions. So you can email me, that's Eric at boardwalkwealth.com, or you can also email or contact Omar. Omar will leave you to final thoughts.
Oh, thank you, Eric. And look, thank you everybody for watching. We really appreciate your trust and your partnership as investors. We are always very grateful. I know it's a big honor for us because we know you can go take your money somewhere else, and we consider it a big honor. And in some cases, it's kind of like a burden managing this money because we know that this can be invested somewhere and we want to do the best thing. So I just like to leave you with the thought, I know it's an uncertain time, but we can continue to make money. Astute investors do make money. We have to reduce our tax burdens and we have to build our wealth together. And as long as we remain prudent, vigilant, we never kind of overextend ourselves around, which is exactly the entire Boardwalk Wealth Foundation, then lots of great things happen. But great things happen over the long run. Rome wasn't built in a day.